Welcome to this week's Desk Side Chat. Once again, our guest for this week is Jason Priebe. Jason, appreciate you joining us.
Absolutely. Glad I can be on here, John. Should be fun.
It should be. Our topic this week, Jason, we've talked about this a little bit, is managing relationships, managing money, or both. And we're going to get into that topic and talk a little bit about what you are doing at Priebe Wealth Management. But if you could start, Jason, just provide a little background on yourself and Priebe Wealth, and so people understand where you're coming from.
Absolutely. All right. So a little bit of background on me. I am about 8-9 years into the business. Went to undergrad, then went to law school, then decided I wanted to get into this industry. My father was in the industry as well, so I had the benefit of being able to join and learn under him for a number of years before he retired. Our practice is now up to the point where we have about 250 to 300 million of assets under management, depending on, the day. We all know how that volatility is going recently. Yeah. And we have a team of about 8 of us, right? So there are 2 of us advisors, and then we have 1, 2, 3 other licensed staff. And we have an additional 3 unlicensed staff, including a CPA who runs our tax and accounting practice. And so we are definitely focused on financial planning. And so I think this topic makes a lot of sense and comes up quite often in how do we manage the assets and how do we manage the clients and their relationships as you continue to grow. And for us, that has meant really going to a models-based approach for our clients for their investment management so that we can focus on the relationships and really on the planning side of the relationship.
Yep. And you and I worked together for a couple of years in my previous role, and in my role, a little background on where I'm coming from for anyone who's new to this. I was a regional wealth consultant for LPL, and in that role, among other things, part of what we were doing was helping advisors to move into more of a models-based approach and talking about the importance of having scalability in the practice. And Jason, you and I have talked at length about the importance of being able to do both, because really what it comes down to at the end of the day is you have to deliver that customer experience, that customer service that is going to keep the clients committed in their investments, keep them committed to the plan. As you mentioned, it starts with the plan, but so much in our industry is still looking back at this historic mentality of managing money first. So I guess, at what point, or was this something that you've embraced from the get-go, or is this something that was an evolution as you were getting into your dad's practice and kind of understanding the flow of the business, moving to this more models-based approach?
It was definitely an evolution. When I was first introduced to the world of financial planning and financial advising, where we came from, we weren't model based at all. In fact, we didn't have discretion at the time initially. And so we were very much, in a way, transactional. I mean, we were doing financial planning, but in order to get stuff done and be efficient with managing their money, we were transactional in nature, in which we would call them up and say, hey, we want to make some adjustments to the portfolio. And that would be the focus of the majority of meetings. Even the review meetings was focused on, what are we doing with the assets? Because we haven't been able to make a change with them since we last spoke. And so that was always the focus of those meetings. As the industry has evolved and advisory has really taken off, it's opened up the channels that we have for our platform at LPL, platforms in which we can be discretionary with our clients. And we can choose the type of level of model management we want to have. So I've gone very far into models-based management for my clients in order to spend less time talking to them about money and what we're doing at any given moment within the markets, and focus more on the holistic long-term picture. Yes, investments is important to that, but it's only the beginning. And so it's allowed us. So at LPL, we utilize the majority of our assets are on advisor sleeve or MWP, because it gives us the ability to have more time focusing on the relationship with clients, less time on actually transacting the investment accounts. That being said, obviously, there are, it's not a hard and fast rule. We have a lot of assets that are also, while models based, are not directly in a model, because non-retirement accounts, obviously, we have to be aware of capital gains and tax situations and all those types of things. So it's not to say that we are 100% models. You put a client in a model and that's how we run. That is not by any means, but we are models based. That lets us have our focus on client meetings with what's going on in their lives. What do we need to be aware of? What do we need to be planning for? How can we be more tax efficient? Should we be doing Roth conversions? What should we be doing for beneficiaries, for estate planning, for legacy planning? All those types of things have a much greater impact than, the day of, we're going to shift a little bit out of emerging markets or a little bit into, large cap in the US, right? Right now is a very good time in which, if you haven't been focusing on the relationship and your focus within a practice has been on investments, you're going to get tons of calls right now with what's going on with the markets. What are we doing? Where are we selling? Where are we buying to? What's going on? Whereas the majority of the calls that we are getting these days, yeah, people are nervous about the markets, but the questions are not, what are we doing? What changes are we making? What are we buying? What are we selling? Where are we going? It's, are we still on track? Do I need to be making any adjustments within our plan, or are we all good? And for those who have been on track and have been running according to their plans, we're good. We're in good shape yet. And so the conversations we've been having with clients these days is far more focused on the plan and where they're at, as opposed to the portfolio is down 10% or 15% or whatever it is at any given moment, right? It lets the focus be on the client, as opposed to the transactional nature of the way the business always was, of what are we buying or are we selling today? And having them approve and sign off on moving from one fund to the next fund, right? We don't have to have that. So they don't focus on it because we're not focused on it. The client tends to focus on whatever we focus on, right? And so if we focus on what's important to them, what are their actual goals? What are they trying to do? Are they trying to spend more time with grandkids? Are they trying to travel more? Are they trying to, work on a project? What are those goals? And if we focus on those, then that's where the conversation is going to lead, whether the market is going up like it has been for a number of years, or whether it's going down like it is now, or any given moment, right? It lets you lead and give the focus with that client relationship where it should be.
And I love how you say that. It's, focusing on what's important to the client, and really that's what's going to drive that discussion. That's where things are going to go. But going back, through this evolution, there's certain biases and perspectives that clients have, and moving to a discretionary model, making these changes, it has to be, it's a different dynamic for the clients. How did you go through that process in explaining to the clients the difference in terms of how you were going to be managing, and how that fit into the picture going forward with some of those clients that may have had more of a perspective on, hey, you're going to call me with a hot stock tip today. That's what I'm expecting my advisor to do.
Right. Yeah, I think the biggest thing we focused on was the fact that, how often do we talk, right? Whether it's 3 months or 6 months, or a lot of the clients, some of them, they get busy and you only meet with them once a year, right? You might have interactions in between, but not real in-depth conversations. And so even if they were used to us calling and saying, hey, we need to make a move or we need to make an adjustment, it was very quick. It was as efficient as they could allow it to be, right? And so by focusing on the fact that, hey, part of the reason for moving to advisory and discretionary is so that we don't have to focus our time, the time that's so valuable to you, we don't have to take it and spend talking about the specifics that we are going to be investing in today or tomorrow, or the tactical adjustments we might be making because interest rates are going up or inflation is very high at the moment. We don't have to spend our time on those adjustments, right? We can spend our time on what's the most important to the client and reiterating with them what is most important. And we want to focus our time when we're spending it, and we're taking your time and we're using your time. We don't want to waste it doing the things that we already should be doing for you. We want to spend it on the things that are most important to you, the things that we can't do without you. And we can do your investment management without talking to you, right? Now, we can't do the long-term actual investment management, but the day-to-day tactical, we don't have to spend time talking about the day-to-day tactical management of your portfolio. We need to spend time, when we're taking up your time, we need to spend it on what's most important, which is, are we on track? Are we, hitting all of the different pillars, right? So with our clients, that focuses on what we call the due north formula. What's our clients due north? Where are they headed? It's a direction, right? Are they headed to retirement? Are they headed to, spending more time with grandkids? Where are they headed? And are we protected? Do we have insurance in place? Are we tax efficient? Are we managing the tax efficiencies? Do we have, cash on hand for anything that might be coming up? Do we have an estate plan in place? Do we have that legacy in place? How are we doing that? Do we know the kids? Do we know their tax situations, right? So that we can be managing all of those different aspects and focusing on the true big picture when you're spending and wasting it. When you're taking the valuable time from a client out of their day, we want to make sure it's on the most important things and not on, a day-to-day tactical or month-to-month tactical change within a portfolio.
And as you mentioned earlier, though, the investments and how that money is invested, it's important, right? It's foundational in how that plan is going to accomplish the goals that the clients have. You're a great representative for this topic, the both, right? Managing relationships, managing money. And for those of you who are not familiar with the advisor sleeve program and how that works, that's allowing advisors to be a portfolio manager and to scale out and utilize tools to actually manage. Jason, what are your thoughts on, there's another level where you can fully outsource completely the money management. You're doing a hybrid version where you're still having that control. What are your perspectives on the pros and cons of owning that yourself versus outsourcing it completely to a separate manager?
Yeah, I think you can really go two directions there. I think completely outsourcing investment management, if you have trust in the person that you're or company that is taking that investment management on, I think it's a great route to go. The reason we haven't specifically gone that route, and we keep the investment management and the fund selection, the stock selection, and the tactical adjustments in-house and within our practice, comes from a standpoint of what I call legacy, right? That is one of the things that clients have been used to, is one of the things that we do, right? And they're very accustomed to that. And so part of that has to do with our own specific client base and how used to they would be to us saying, hey, we're going to take it out. We're going to let somebody else completely run that for us, versus the comfort level of, hey, we're going to still do it for you. We're still doing it, but we're not going to execute on the trades. We're going to let our custodian execute on those trades within the models that we're selecting, right? That's just kind of a personal preference. I could very well see moving to more of a third-party money manager where we completely outsource it, but it's not a route we're going to yet. And I think part of the reason for that is because I think being involved on the investment selection, the fund selection, and the tactical decisions is an important thing to be able to have conversations on an ongoing basis with clients as to what to expect and what's going on and what we think the markets are going to do, what we think the economy is going to do, right? Because of course, investments is a very important pillar when it comes to the things that we do with clients. And so I think maintaining that in-house is something that is worthwhile.
And one of the challenges that you can run into in terms of having that business model where it's scaled out, models-based, discretionary trading, is you can start to become excessively tactical, and sometimes the clients might expect that. So how have you maybe handled some of the client concerns over the last couple of months where clients are like, hey, we need to make changes, you're trying to focus on the long term? I don't know how specific you want to get into the tweaks you've made in the portfolios, Jason, but how have you handled clients that may expect you to just be very hands-on and active in an environment like we're in right now?
Right. So I'll start from the basis of how we manage and how we tell our clients we're managing their assets, right? And that starts from, we are models based, right? And so from the model, how do we look at that model? How do we review those models? How are we reviewing that? For us, that's done on a quarterly basis. On a quarterly basis, we are running through all of our funds that are within the portfolio and making sure that they're meeting their criteria that we have. We have a list of 10 different criteria that our funds need to be meeting. And if they're not, if they start falling down and not hitting all of those criteria, then they will start flagging. And at some point, we may make the decision to replace them. As far as the decision as to weightings for different areas, asset classes, again, done on a quarterly basis. We'll review, in our case, to get really specific, we take BlackRock, Goldman Sachs, and LPL. We review their macro views on a quarterly basis, and we come up with our own consensus as to how we want to manage our money and any tactical moves we want to make on a quarterly basis. Typically, we're not making major adjustments. Sometimes we might not make any adjustments to those tactical decisions. If there are outside events going on, we may look at the portfolios in between interquarter and make a decision to make a change at that point. One of those times that I can jump back to would be when COVID was first coming up, March 2020. There was a very, very quick sell-off. We made the tactical decision as the S&P kind of started hitting down 15, down 20 to just do rebalances back to our regular weightings at those points. That would be something where you can say, hey, it was a tactical move. We didn't know how much further it was going to continue to go down. We just, philosophy wise, we expect markets to go up over the long term. And anytime you're getting 10, 15, 20% moves down in the broad market, that's typically buying opportunities. As what's going on right now with the markets, I haven't really made a lot of specific tactical moves at this point. The biggest tactical move I would say we've made would have been back in 2021, which was reducing our bond exposure and moving more into alternative asset space, just because our expectation was that interest rates would be going up. And then as it turns out, we've had a big run in inflation, and now we have a lot of interest rate rising going on, right? And so we can look to those pieces and say, hey, these are areas that we've done, that we've hit on. But otherwise, we're not making a ton of massively tactical moves. We are not by any means going all out of international or all into international or anything like that. When we're talking tactical with clients, it's usually a less than 5% weighting move from one area to the other.
So when you're setting up client expectations from the beginning and really honing in and focusing on their plan, and really focusing on investments are just a piece of that. And so now when there are environments like this, it's just helping clients, kind of look back, hey, we're focused on the plan, and this is how we're managing the money from an ongoing client relationship basis. How do you incorporate investments into your process as you're meeting with the client, you're reviewing their plan? How do you get engaged in that investment conversation when the clients are maybe expecting it, and what, I guess, any in market environment, but maybe especially right now?
Yeah. I think that's where we spend 5, maybe 10 minutes going over the portfolio, letting them know where performance has been at, our expectations moving forward, our current asset allocation, and our expectations with the economy based off of whatever our last quarterly review was for our models and our investments, and spending 5 to 10 minutes on that. Then times like these, there's a couple of things that we really like to pull up within a client's plan. There's 2 things. The first is just literally going, so we use eMoney. So the first is going into the decision center, showing them their entire plan built out, and going through the Monte Carlo and showing them that despite the movement within the portfolios, we can run this Monte Carlo simulation and we can see that we're still on course, right? The other one that I really, really love is I will pull up the net worth report. And instead of using the net worth report, there are 3 little options there. One of them is called the wealth tracker. And I will put their wealth tracker up for the last 5 years. And what it does is it takes their net worth and it shows you what it's done over the course of the last 5 years. And it is a really awesome tool to use when we're going through market volatility, because you can slide back and you can show them, look, you might be down 15% right now in the last 4 months, and that feels terrible. But all we have to do is slide back to, at this point, it's somewhere in 2021, and we're still at a higher net worth or higher investments than we were at that point. That's less than 18 months. Okay, whatever it is you're going back to, it's short time frames. Okay, look at where you were 5 years ago, and for most clients, if you're looking back 5 years ago, I mean, their net worth is dramatically lower 5 years ago than what it is now. And so just reminding them how short this time period is where we're seeing volatility, and that over the course of time it goes up, and you can even see the other points where it's dipped back in 2020 when it dipped for a couple of months. All those points, it lets them remember that this is normal, that it's normal to have moves in the market. It's a roller coaster. It's not going to be straight up. It's going to have dips. It's going to have peaks. It's going to have valleys, right? And so if we can remind them of that they've actually gone through those same dips and those same valleys before during different time periods, and we got through them just fine then, we'll get through them just fine now. And pointing out that short time that this is right now really helps settle a client down and realize that, look, investments are important, but if I get caught up attempting to move out of the way of something that's going down or try and time it to catch it on the way up, we're going to end up hurting ourselves and moving ourselves off of our plan, right? Which is, how much risk should I be taking at any given point in time? Risk is also, to go a little bit off course. Risk is really, it's relative. And I think we're seeing that in today's market, right? We've always been taught you have bonds to de-risk, right? Get a little bit of return, but keep the risk off. And in today's world, bond portfolios are down nearly as much as the equity side. And so even though a bond portfolio is said to be, if you're looking at a risk score, we use risk wise, and, most bond portfolios are right around 30, and most equity portfolios are at, 70, 75. In today's 4 months, in the last 4 months, their risk is nearly just as bad, right? I mean, they're both down just as much. And so I think it's a great way to remember that risk is relative and risk is not static, it's ever changing. And so that's why we use diversification, because there are areas of the market that are holding up much better than what your bond portfolio is doing right now. In our portfolios, it's large cap value dividend paying funds are holding up very, very well. Managed futures are holding up very well. You have real estate that's holding up quite well. And so it's a great way to go in right now and look at an asset allocation and explain to clients why we are diversified. Because although historically bonds are the safety side of our portfolio, and that's where we want to be for safety, it's not where the safety is today. And so if we were to be allocating entirely in one area or another area, or trying to time what's going to be going well at any given moment, we're going to get hit and it's going to hurt really bad. And that's why we focus on diversification, not just bonds to equities, but real estate, the other areas of the portfolio, managed futures, why your equity portfolio is not all growth, it's not all value, it's not all small cap, it's not all large cap, right? We want to be spread out, and there's a reason for it. And in our portfolio in particular, our equities would have lagged per se over if you were just looking at it based purely off of equities, because we've held a much larger position in large cap value dividend paying portfolios. And over the last handful of years, with growth just going crazy, the growth side of equities, that's made equity portfolio like ours look like it's lagging. And if the clients don't trust how you're designing your portfolio and don't understand why you're designing your portfolio the way you are, which is not for a short-term time frame, but a long-term 10, 20, 30-year time frame, that's why you're maintaining your allocations the way you are in your diversification. Don't get caught up in the day-to-day or 6 months or year-to-year basis of what's happening within the markets. Stick to the long-term diversified asset allocation. That is what the client should be having. Don't get caught trying to chase the portfolio. Right? Don't chase the market returns, because it will bite you if you do. And so showing the diversification and why you have what you have during periods of volatility is really important. I've had plenty of conversations in 2021 as to why we were holding our large cap value portfolio, because it was always lagging. It's been lagging for the last couple of years. And really, it wasn't meant to be a pure equity, try and get the S&P 500 type return with that portfolio. It was meant to give us a little bit more safety within the equity portfolio, so more than a bond portfolio, but give us a little bit more safety. And you can see those plays. What happens now, right? In the last 4 months, that dividend portfolio has held up very, very well. And all of the lag it had in 2021 or even 2020 is more than caught up in the first 4 months of this year. And it's a way to help ease the client's mind when it comes to what we're doing with the investment selection and the investment management. Because our growth portfolio, obviously we have growth individual holdings, and we all know they're getting hammered right now, absolutely hammered. There's no way around it, right? And so that's why we want to make sure we have that diversification, so that we can show clients quickly why we keep that long-term view within a portfolio, because it comes down to their plan. What are we expecting them to need for their assets to do in order to be there for 10, 20, 30, 40, however many years it is, right?
What, Jason, in your case, what is your So you mentioned, risk can change over time, portfolios change. Your investment committee is meeting on a quarterly basis to reassess the actual positions. What is your rebalancing strategy overall, and does it change at all based on the client's risk or account type?
Rebalancing strategy, not so much. Risk is always, how much risk we're taking on within an individual specific client's portfolio is always going to be based on that long-term plan, right? So to keep it simple, as the client's getting closer to retirement, we're going to want to slowly de-risk that portfolio. When they're 5+ years out from retirement, we want to maintain a much more aggressive posture within those retirement accounts. Might be different on the non-retirement account side, right? Something that's more liquid, they might need to access on a more shorter term basis. We might keep less aggressive. And so that's kind of where the bucket management is coming in as well. Because just because a client as a whole might be at one risk level, it doesn't mean that every account or every bucket within the portfolio is at that same risk level.
How, in your case, and you talked about the size of your practice, a couple $100 million under management, how many models are you running with right now? And do you have models that are on like standby that might get incorporated? Like overall, how many models are you just overseeing, and how many are you utilizing, I guess, in the general practice right now?
Yeah. So on retirement account sides, we're managing about 7 models. Okay. On the non-retirement account side, we're managing about another 6 to 7 models. On the non-retirement account side, that's where those portfolios are. We attempt to manage them as much to the model as we can, but we will make discretionary decisions for specific clients based on their tax situation and tax consequences and what we're looking at doing. So although non-retirement accounts are models based, they rarely, if ever, actually hit the model because we are being tax aware. Okay. On the retirement account side, we don't have to worry about that. So they're hitting the models 9 times out of 10, whatever model they're in, they're going to be right in line with that. But on that non-retirement account side, we're going to run a handful of more models. The models are going to be a little bit more loose in the sense of, let's say we have a US large cap growth fund and we make the decision to remove that from our model. We might not make that change in every client account. We might have a substitute, the existing fund that they have ready, that is able to maintain a weighting in replace of the primary fund because of tax consequences, right? And so those are where we're very much model based. The allocation, the broad market allocation, is going to be very, very similar to what the model is in most non-retirement accounts, but it would be the fund selection underneath that will start to vary a lot more over time, because we just can't realize tax consequences nearly as drastically as we would like to if we were going for pure model style.
And that just adds to the value that you're delivering to the clients. I mean, how important is it to focus on after tax returns? I mean, that's, it's a massive value add in terms of what you're doing for your client, in addition to everything else you're doing. I'm excited, Jason, we're going to need to, because you've shared a little bit about your due north formula and your process. I'm excited. At some point, we're going to probably have to get into that topic and get into more details. But this week, just focusing on this particular discussion, I think is going to be very impactful for a number of advisors, because there's different opinions, there's different thoughts on how to manage money, how to incorporate that into the planning process. So we will look forward to engaging in this topic all throughout this week inside the group. So please join us on Wednesday, our Hear from a Peer roundtable, where we'll jump into this topic a little bit more. But at this point, we'll open it up to our members. If anyone wants to jump in to a backstage pass with Jason today, we can talk a little bit more about this topic. But Jason, thank you so much for joining us. Really appreciate your time.
Absolutely. Sounds good. Thanks for having me, John. Appreciate it.
love.